All right, today is Monday, November the 9th. It's the 2 p.m. section. Recording is on. So in just a few minutes, we're going to start going through the Merck Homework 9 valuation to get us ready for next week on Wednesday, November 18th, group case 3, which is the valuation, will be due and presentations will be done during that class. The valuation as the group project is going to be on CVS Health, if you haven't figured that one out already. So you're going to probably want to get started on that if you haven't already as teams this week, getting ready for that presentation. Again, you'll have 10 minutes, just like you had in the previous 2 cases. You'll turn in your 4 models. You'll do a PowerPoint presentation rather than a paper, and go through what we're going through and all of the assignments. Okay? So today, again, we'll talk about Merck. In Wednesday's class, we'll spend a little bit more time doing another practice valuation. You'll have another individual assignment due next Monday, which will be homework 10. Should be another evaluation, and then the following Wednesday will be the group cases. And then after that, we'll talk about multiples, which will be the last content for the end of the semester, which is quickly coming to a close. So we did have 2 changes since we last met. Change number 1, that is substantial, which affects all of us. There was the election winner declared on Saturday. Looks like it was going to be the Democrats, Joe Biden, for president. Saw these spontaneous celebrations that spilled out into the streets, which doesn't usually happen in presidential elections. And also, we now may have a president who has to be evicted from office.
Are you serious?
I don't know. Am I serious? I guess you're not talking to me. But in any event, we may have a president who doesn't want to leave. So that's going to be an issue. The other thing that came out this morning, if you weren't paying attention, go ahead and share my desktop just to point this out, is Pfizer came out with some potential good news on a vaccine that said preliminary data showing it to be approximately 90% effective. And essentially, it probably won't be that great, but if it's anywhere near that, that's a big deal. So stocks are up pretty dramatically. If you go to WEI and Bloomberg, you can see that right now the Dow's up about 5%, the S&P is up about 3%, NASDAQ lagging about 0.5%. Because as you look at companies like Zoom, which are, Bloomberg was calling them the stay-at-home companies today. Zoom, U.S. equity, are getting crushed. Their share price is down $67 a share to $432 as people think that they're going to be freed from their houses and businesses and be able to move around, which means on the other side, I was looking up this morning, companies like Royal Caribbean, the cruise ship operator, today is up $16 a share. United Airlines up $6 a share to 41. So you can see that different companies, different industries. Generally, the market's going up, but people are now starting to understand what it means if we do have a post-virus world the next 6 to 12 months. Who's going to win? Who's going to lose? And you're seeing the moving in the market today. Although still, on a very unfortunate news, we're getting over 100,000 people infected per day and still a death rate above 1,000, which is very unfortunate. So hopefully everybody realizes that on the one hand, there is a potential, the COVID one, there is a potential cure out there, but if you actually look at it, we are a ways from that actually happening, and people still need to be more careful over the next months until that happens. But regardless, back to the Bloomberg trading simulation, idea or T message, just to check in to see where our class is. Section 201. So this would be the results as of today. Portfolio value. Again, you have to do at least 10 longs over the course of the second half of the semester. So one team needs at least 4 more. but this team seems to be surging ahead of the class right now with about a 12% return. Others all in positive territory, but that's the ranking as of today. All right, questions about any logistics or the trading challenge? Anything about that before we get into the Merck valuation, homework 9?
Yeah, what does Team 1 own?
You'd have to talk to Team 1. I can't.
Do not tell them, please.
I was going to say, I'm not going to go into their portfolios. They can decide whether they want to give you realistic or not realistic information in the chat. But that's up to them. All right, any other questions? All right, so let's talk about the Merck valuation. I'll give you a hint that the Merck valuation was probably harder than you thought it was going to be. As the plug and chuggers out there, I thought you just throw a bunch of numbers in, everything would work fine, and it may not. And I'll also give you another hint that the upcoming CVS Health valuation for Group Case 3 is also going to have a similar challenge to the Merck valuation, which is one of the reasons why I chose Merck for this assignment. But let's go ahead and talk through the process. So what I'm going to do, excuse me, is start out with, we'll go back to target. I'm going to take our target model. We'll use our as is from target as the starting point for the Merck as is. So I'm going to go ahead and save this. You could have used the Walmart one as well, but instead of target, I'm going to call this the MRK as is, and this is section 201. And I'm going to put this in my homework 9 folder. All right, so the first thing we need to do is we need to update the data with target, with Merck, or whatever company we're using. So essentially, we go to Bloomberg. We go to the company, MRK US Equity. We went to FA. You would have then gone to your model that you were, custom. Then to the model that you were exporting. And then you would export Excel current template. Right? Now, I'd already done this morning. And that would have been, back out here to homework 9. That would have been the Merck data file that I had saved. When you get to this file, make sure that you take the long dashes, replace them with zeros. And then after we do all that, we're ready to copy and select that data, put it into our, what used to be target model to make it the Merck model, paste special values. We've now overwritten with the Merck data. We then go to our CFI to check to make sure that it's still in balance, which it is. Okay. Now, once we've done that, we then go to our assumptions and we start updating our assumptions. Well, the first assumption was the last reported year. Now for Walmart and Target, it was 2020. But for Merck, you can see here, it's 2019. Right? And this is just a change with the retailers. So what the retailers are doing is they are wanting to capture the entire holiday Christmas season of shopping into their numbers. So they've shifted their calendar year to a fiscal year that ends just January 31st. Okay, where the rest of the world, including Merck, is still on the calendar year equaling the fiscal year December 31st. So in a way, Walmart and Target were ending January 31st, 2020, which is really their 2019 data. But regardless, the model doesn't care. Our last reported year would have been 2019. So we change this to 2019. Continuing on, probably leaving operating cash okay, 2%. Now we go to WACC. Again, I had taken the screenshot for WACC earlier today. Merck's WACC 5.6%. So we come in here and it's pretty close to the one I had for Target. And then I go to my DES screenshot. We got two pieces of data here. One was the shares outstanding for Merck, 2,530,000,000 down here. So change my shares outstanding to 2530. And the other piece of information we'll use for the screenshot is the share price at the time of valuation. I did it right before the 11 o'clock class today. So 83.57. Whereas the market was opening, it was already up $3 a share. So I'm going to put this in here at 83.57. Now, again, your share prices are probably at 80, which is fine. But, somewhere in there, just have to do it based on the time of the valuation. Now, continuing on with my assumptions, the third screen we're going to need is the EEO. And we're going to put in the revenue and EBITDA forecasts that Wall Street had come up with, consensus estimates. So basically, we're going to update this data in yellow. So starting with 2020, the consensus revenue estimate is 48,120. So I'm going to type that in. Then it was 51,607. And then 54,347 and 55,719. And then my four EBITDAs would be 20,055, 22,119, 23,780, 23,410. And then my multiples. Now, this was the next question that came up. Since 2019 was the last reported year, forward year one, forward year two. Forward year two is 2021. Now, for Walmart and Target, it was fiscal 2022. Okay. Again, this is why I say count the columns. Don't worry about the numbers. Right. It's first forward year, second forward year is 2021. So in this case, 2021 multiples of sales, EV to sales, 4.52. EV to EBIT, 12.28. So then we go over to our ratios, and this is the target data. So I want to make sure that I don't have any hard-coded numbers. So I'm just going to reset those to be equaling the previous year. Because again, these are target EBITDA margins, which are far different than the Merck ones. So I want to, again, equal the previous year. And then we'd also change the tax rate, which I want to start with a placeholder to be equal in the previous year. And those were the major assumptions on the ratios that I had already changed. So what do we need to adjust? Right. Well, first of all, back to the assumptions, we need to get our EBIT margin at 36.81%, which is tab that number. So essentially, that's going to be something like 44.6, 44.61, give an extra decimal place. And that's 36.81, which matches the 36.81 perpetuity number. So next, I'll need a tax rate that's more realistic. Because again, this was the last year's tax rate. So we go to two areas for tax rate in Bloomberg. But the simple one I said is if we go to the company's EVT, company events, then we look at the last earnings call, which Merck just had an earnings call on October 27th. And this is the actual press release. That's the transcript. So if I click on the transcript to the earnings call, this is the last earnings call. And if up here I search for the tax rate, I can see that tax rate came up 3 times. And essentially they said the quarterly effective tax rate was 14.8 and our full year is expected to be 15.5, blah, blah, blah. So check the analysts, but they're probably going to be closer to these numbers, mid to high teens, 15.5. Okay. And then I might want to smooth this one out, 44 to 42 to 44.6, so 43, somewhere in the middle, just to kind of smooth out those earnings. But the point is, now I need to get the share price to come closer, down to 80, 138, up from 83.57. Okay. So how do I do that? Well, let's go to my assumptions. Well, the first thing is I need to find a G that works, right? And right now I don't have a G that works because my model EV to EBIT is 1894, and I need to get to 12.28. So obviously I'm going to start lowering my G, make it 0, lower it further, negative 2%, something like that. Probably not. So negative 1.65, I think is the actual number. So negative 1.66. Somewhere around these numbers. 1.6, probably good enough. Close enough. Negative 1.6%. So here's the point. Somewhere around a negative 1.6% G, I get to price that's pretty close based on the EV, the EBIT multiple, and I can worry about my two numbers. But I still got to check out this CVG. So I got several people who emailed me over the weekend that said, can you have a negative G? So I'd like to address what that means. So if I come over here, there's the draw function. What does a negative G actually mean? Well, if I were to draw, and this is our cash flow value over time, and I think about G is growth of cash flow into perpetuity. So if I think about my free cash flow valuation here and a slightly negative 1.6% and plot it, I get a line that's supposed to be straight that's heading down. Okay, because what I'm really saying is the company has peaked, and going forward doesn't mean it's going to go out of business, but a negative 1.6% G means that the future is worse than the past, the present. Okay, so I expect that Merck has peaked and its performance has gotten lower. That's basically what a negative G means, right? So is it theoretical possible to have a negative G in a perpetuity? Yes, right? But does that make sense given the data that I see from Merck? Well, if I go back to Merck, a couple things. One, on the EEO, I'm not seeing declines here. Actually, I see revenue growth year over year over year. If I switch these to percentages, they're growing 2%, then 7, then 5, then 3. I'm not seeing growth slow, much less go negative. And whether it's EBITDA, maybe a little bit here, but into perpetuity, I don't know. So second thing is when I look at the ANR and I look at what the sell side analysts are saying, sell side analysts are actually putting a pretty strong buy on Merck. 18 buys, 5 holds, no sells, target share price of 96.42 with basically a 12-month upside of about 18%, even today with the $3 or the $1.42 upside, or $3 this morning. So the point is, I look at all this, I'm just like, I'm having trouble thinking that Merck is a company that's peaked and has gone into decline. Okay? So scratch my head. So this is where I go back to, sometimes you can't just plug and chug, because when you just plug and chug the data into the academic formulas, they don't always make sense. So you need to do a little bit more investigation here. So what I'm going to do is I'm going to go back to BRC. I'm going to see, because the analysts got to be facing the same thing I am. Are they talking about this? So I'm going to just do a search here in the analysts for WAC. And the first analyst report that talks about WAC is JP Morgan. So let's pop that one out. And this is a model update that JP Morgan did in early November after the earnings call in late October. And essentially, they talk about their valuation model changes. Blah, 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 blah. But I want to come down here to this paragraph. Assuming you can read this. Make it a little bit bigger. Oh. Read the paragraph that says valuation, and then somebody tell me what that means we should do.
Should we change the growth rate to 0 and the WACC to 9%?
Okay, but I'm looking for just a why as opposed to just reading what they said. What's really going on here? What's JP Morgan saying? Translate to English.
Just the sector hasn't been performing as well with the COVID, so that's been messing up and creating issues for the sector.
But what does WACC really represent? What does WACC represent?
Isn't it the cost of doing business?
Yeah, based on risk, right? It's a representation of the risk. So the WACC is going to be risk adjusted. So you have more risk, have a higher WACC. So what is JP Morgan basically saying? What they're saying is that we think that the risks facing Merck and probably other pharmaceutical firms is probably higher than what Bloomberg represents. And so therefore we're representing it with a model WACC that's higher than what Bloomberg is giving us. It's exactly what I was talking about last week. That was the hint going into this assignment. Because as I said, most of the time you use the Bloomberg WACC, everything's fine. We used it for the retail firms, and there was nothing wrong with using that for the retail firms. But we get to the pharmaceutical industry, and right now, the industry, the analysts, probably the buy and the sell side, are worried about the WACCs. They're worried about the risks, right? Now, let's just take this outside of Bloomberg for a second. The Democrats and Republicans didn't agree much in the campaign. All right. It's like we live in two different realities, much less two different countries. But essentially, they did agree on one thing when it came to the pharmaceutical industry. What did both the Republicans and the Democrats both say about pharmaceuticals? In our political season, what did they say? These are prescription drugs.
Do they not like the pharmaceutical companies?
Why not?
Because they're charging too much?
Okay, so let's take this. I gotta kill this stupid Microsoft magnifier thing that I turned in. So let's go back and talk about how then you put that into a model, right? So if I think that I don't like, and you can kind of see this here, I don't like the EBITDA margin. That's basically what the Democrats and Republicans are saying. These people make too much margin on their products, right? Now, again, they're taking a lot of risk and they spend a lot of R&D. So I'm not going to get into the discussion of whether or not it's a fair price, but politically, people think that the prices, the margins are too high. Just to put this into perspective, if I were to reopen my target valuation model and look at the EBITDA, it's like 8, 9, 10%, right? With a gross margin of like 30%, right? Merck, you can see this here, has, go back to ratios, gross margins approaching 80% and EBITDA margins approaching 40%, okay? And so if I worry that those are going to be untenable in the future, then there's two ways to adjust those cash flows. And what it looks like JP Morgan is saying, I'm going to adjust the model by basically saying that the riskiness of the cash flow is higher, whether it's beta or risk premium, and therefore I'm going to charge them a higher discount rate. So essentially, let's go back to my assumptions. If I use a 9% WACC, so I'm going to stop the drawing here, and I'm going to go to the WACC of, actually, try and get rid of that chart. Let's save it in our model. Yep. If I use a 9% WACC, then in order to get my share price to match, I can't have a negative G. probably going to need to have a positive G. So positive 1%, positive 3%, getting close, 2.6, so 2.9, something like that, getting close. Oh, sorry. Actually, I'm trying to match the these two multiples here. 2.6, 2.65 is I think what we said earlier. 2.65. And so that's another way to basically match these multiples, which is actually getting the share price pretty close too. So here's my point. Which of these two stories makes more logical sense to you? That Merck has a 2.65% G and a 9% WACC, or Merck has a negative 1.6% G and a 5% WACC?
The 9% whack.
So this is what we need to think about for our as is, because this is more realistic. And so this is why I go back to, you can't just plug and chug. As you're putting the data in, you have to think about what you're actually putting into the model. And every now and then you're going to put data in and you're back solving for things that are not going to make sense. And this is an example of something that should have caused some cognitive dissonance. Because if you looked at the data on your screen and then you say, oh, suddenly this is a negative G, Merck has peaked and it's getting worse, like that doesn't really fit with what I'm seeing. And so why is this being caused? Well, the low discount rate is actually inflating the values of those cash flows. So maybe the market isn't using that discount rate. And so as you start reading and doing any research, you quickly see that they're probably not. That the buy side and the sell side have decided to apply different hurdle rates than what Bloomberg is giving them to these companies. And these companies are trading at a different cost of capital than what you would see in Bloomberg. So this is an example of an exception. So finishing off, ratios. What's left? We're probably looking at 3.5% growth in the out years. And now I'm within 50 cents of my share price. That's more likely to be my as is. I'm going to give you one more clue. We're now getting ready to set up our bull and our bear. So I go to my multiples and I get rid of the multiples for Target and I put in the multiples for Merck. Now, here's the thing. When I put in the multiples for Merck, this is at the time of the valuation, copy, again, edit, paste special values. Here's the point. I'll get the same multiples, whether I use the negative G low WACC or the higher WACC positive G. But what really starts to jump out at me is all these other companies. So Merck is trading at a little bit of a discount to all of their peers, particularly the market cap weighted average, big pharmas globally. And I'm just going to do a quick what if here. But if, and this is a prelude to what we're going to get to in the multiple section of the class coming up in about a week or so. But if I go back to my valuation model and I put in a WACC that's 5.6%, that suggests much higher multiples. Because one of the drivers of multiples, think back to key value drivers, is the cost of capital. And with a very low cost of capital, I would be seeing much higher multiples. Well, as I look through the industry, I don't see much higher multiples at hardly any of these companies, especially in my EV to EBITDA, EV to EBIT, and PEs. None of these companies are trading at crazy high multiples. So what that suggests to me is that this is an industry issue with cost of capital, meaning what the buy side and the sell side have chosen to do, for better or for worse, when they value pharma, they're not using the Bloomberg WACCs. They're using higher cost of capital across the industry. And you can kind of see that in the multiples here. So if I had to say which of the stories do I think is more true, it's more likely to be this one. The WACC is closer to 9, and this is the CVG for my as is. I'm going to pause because I know that that was pretty advanced and see if you had any questions. Because what I'm really saying is, if I go back to my drawing here, and I'm drawing my cash flow value over time, then instead of a curve that looks like that, which is the negative G, I think that the curve would look more like that into perpetuity. And so in order for the curve to look like that in perpetuity, the top line, I need a higher hurdle rate, higher discount rate in order to do that. So that's what I'm saying. Which of those two cash flow lines seem more reasonable to perpetuity to me and Merck? Slight growth in the future, slight decline in the future. I'm more on the growth side, high cost of capital, than decline side, low cost of capital, even though both answers mathematically could be correct. Questions, comments, concerns?
Yeah, so for everyone that might have put like a negative G, did we all just fail the assignment? Or is like, how's that working out?
That's a fair question. So no, you did not fail the assignment. And I'm going to tell the TAs when they grade this to accept the negative G solution as a solution, right? However, if you redo this assignment on Wednesday for CVS and you find yourself in a similar circumstance, you need to have a better explanation. And I'm just hinting that you're going to probably run into a similar situation with CVS. But the idea is that you could actually make an argument, as somebody tried to in the last class, that technically the negative G does explain the situation. I can't tell you you're 100% wrong with that. It's kind of like the Democrats and the Republicans. They view the world through different lenses. You can't even agree on what you're saying. And so just playing that terrible metaphor, what I'm saying is that you can make an argument that Merck really does have a negative G, that going back to what I said about the pharmaceutical industry, they are going to have pressure in pricing, which is going to decline their cash flows and make them less valuable over time. Now, that's another way to get to a lower valuation. Okay. Now, the problem is the analysts have not really taken that approach because we're looking at the EEO screen right now. The data is right in front of you right here. And they're actually projecting growth for this industry even in the next few years. So it's harder to believe that suddenly this industry is going to go into decline, particularly this company. So there's some cognitive dissonance here between the data that I see and the mathematical solution that I have. So that's why I go back to, this is where at this point you should be recognizing that something just seems amiss in your story and you need to go back and do some research. And if you do any research and read some of the analyst reports, you start to see that the analysts are actually saying higher risk in the industry is the way they're handling it through higher cost of capital, as opposed to lowering their cash flows right now. Okay. Now, theoretically, they could have lowered their cash flows, but they did not. They're raising their hurdle rates. So, and just, I'm not saying I disagree with what they're doing. I probably would do the same thing. Hence why this is one I think would be my preferred solution, but the other solution is possible. So practically, what does this mean for you? For this assignment, if you put in the Bloomberg WACC and you didn't adjust the WACC and you put in negative G, you will get credit. Okay. As long as you consistently explain that. But somewhere in your write-up, you had to justify a negative G. You had to explain what that means and why basically the industry is getting worse in the future. So when I say explain your assumptions, you got to explain your assumptions, right? And it's easier when you're writing that to talk about it in terms of positive G higher WACC than it is to talk about negative G lower WACC. But nonetheless, in either case, you would have had to come to a similar conclusion that there's additional risk in this industry. Again, questions, comments. This is advanced. That's why I'm choosing this. The exceptions prove the rule, but these are exceptions. Merck is an exception. This is not like retail. Retail was plug and chug, and you're getting a right answer. Merck, you plug and chug, it doesn't work out exactly right. That's why I chose this assignment, to illustrate this point. So questions? And I want to show you where the difference comes from, by the way, because I alluded to this in previous classes. I think it's in the first day of class. So if I go back to Bloomberg and I go to WACC, I hinted at this again last week. This is Bloomberg's calculation of WACC. Okay, they're using CAPM for cost of equity. And if you drill down, you can see their CAPM. Okay, so part of what's being driven is three parts of CAPM. You got a risk-free rate, you got a beta, and you got an RM minus RF. So two things. One, how could Bloomberg diverge from Wall Street? Why would Wall Street choose a different approach? Well, there's two I'll keep it simple, two academic schools of thought on CAPM. How do I do a CAPM? And they start with the RM minus RF. How do I do the long-term risk premium? Well, one way is to say, it's kind of the thing is the Chicago approach, that there is a long-term risk premium regardless of company that we're going to use based on how the markets have done over the last 90 or so years. So I'm going to use a long-term risk premium going back to the 1920s, and that number is typically somewhere between 5 and 7%, somewhere around 6 plus or minus 1. So that should be the RM minus RF that I use in my CAPM. That's one way to do it. Well, that's not the number you see here. Right? What Bloomberg is doing is they're saying, I'm not going to use the long-term risk premium for RM minus RF. What I'm going to do is I'm going to calculate a RM minus RF today, right? Because this is country risk premiums. And if you scroll down the bottom, you have the US premium, which is the S&P 500. And so here's the point. I know the cash flows / dividends that the S&P 500 is distributing. I know the prices of these stocks. Using the Gordon growth model, essentially, I can back into a cost of capital. I can back into an R that makes those cash flows equal that price, right? So since I know the cash flows and I know the price, I can solve for R, solve for the hurdle rate. That's the 8.674. I know the 10-year treasury yield. I subtract the 10-year treasury yield, I get a current risk premium. So what Bloomberg is doing is they're using a market-based risk premium based on actual prices and expected cash flows. So they're backing into it on a market basis. What academics will do is they'll say, no, the markets could be distorted in the short term. Let's just use a long-term risk premium. I think what JP Morgan in effect is arguing is let's not use the current risk premium of the market. Let's use a long-term risk premium. And let me translate why. What they're saying is the riskiness of pharma and or the riskiness of Merck, which could also be in the beta, is higher because of the uncertainty. So therefore, another thing they could have done besides adjusting the RM minus RF is I could come in here and I could say, Merck's beta is not 0.69. Merck beta is something like 1.3. So if I use a 1.3 beta, then suddenly the cost of equity is 11. And when I update that, it gives me a WACC closer to 9. Okay, so I can play around with the WACC. Now it says warning approximation for WACC because this WACC is not the actual WACC Bloomberg is calculating. This is my forced WACC as I change like beta or other costs. So here's the point. If I'd used, I'll go back to my WACC. For my updated WACC, just for kicks here, I'm going to use a country risk premium of 6% and a beta of 1.3. And now I'm going to WACC of 8. So it's probably more like 7 and 1.3. But the point of the story is I can play games with this all day long. The whole idea is that the market is likely using a higher WACC and a lower higher WACC, higher cash flow to get to the value. I'm not saying it's right or wrong, but it is more explanatory of the as is. Now here's the thing. If when we get to our bull and if we get to our target, we think the market's wrong. We think that long-term, the riskiness is actually different than what you see here. Again, I want to save that graph. Then what I could say is I'm going to go back in my bull to a 5.6% WACC and in my target, and I'm going to call Merck a buy. Deal of a lifetime. buy this stock because the market has mispriced the pharmaceutical company because they're using too high a discount rate. And I think that when the people realize they're not as risky as we thought, these stocks are undervalued. You could say that. I'm not saying you're wrong. It's a possibility. Now, there's a second reason, though, why I think they're using higher WACs, which is right now the U.S. government is subsidizing interest rates. Part of the reason why we're seeing all-time low interest rates is the Federal Reserve is just pumping money into the system like there's no tomorrow. And so at some point that's going to stop. And when the government stops its support of the interest rates, then interest rates are going to rise. And when interest rates rise, cost of capital rise. The risk-free rate rises. So right now I could argue that the risk-free rate is artificial. And I think that I'm using a more realistic risk-free rate. So I could be another reason why the WACC could be a little bit higher. But whatever the reason is, I need to kind of work through my details of how I explain it and make sure I explain it with the model. Questions? Comments? About the as is, how I got it, why I'm choosing these assumptions, what needs to change. All right, so this is the point I got to with the last two classes. And the idea is in order to talk about the bull and the bear effectively, as I said, there's some insight into the pharmaceutical industry that you probably just do not have. So between now and Wednesday, and I'll give you the balance of class time today to do this, I want you to look up a couple of analyst reports on Merck, including the JP Morgan one, and I want you to go to the BICO on Merck and understand what the analysts are actually saying about the company, because I think that's going to be important when we talk about our bull and our bear. Okay, so rather than talk about the bull, the bear, and the target, I think we have a more informed discussion if you know a little bit more about Merck. So between now and Wednesday, read the BICO, look at a couple of the analyst reports, and then we'll come back and we'll finish the conversation. In class Wednesday, I'll give you another in-class model to work on for another company to practice. You'll then have a homework assignment, which will be due the following Monday. And then the following Wednesday will be group case 3 on CVS Health. So that's just an update on what's upcoming. But for now, unless there are no other questions, I'm going to give you the balance of class time to do a little bit of reading up on Merck, and then we'll pick this conversation up on Wednesday.
Professor, what was the Bloomberg command to get to the analyst reports?
BRC are the reports. Stands for Bloomberg Research.
Okay. And then what was the other one that you used? The one with A?
ANR is just the analyst rankings, which show you the buy, sell, holds.
Okay. Thank you.
All right. Have a good day, everybody.